At 2:14 p.m. Eastern Standard Time yesterday, something impossible happened. If you were watching the charts, if you were glued to the screen like I was, you saw it, you felt it. The ticker for December silver futures, the pulsating heartbeat of the global precious metals market, simply stopped. It didn't slow down, it didn't lag, it froze. For 11 seconds, the price of silver was deleted from reality. Now, the mainstream financial media, CNBC, Bloomberg, Reuters, they are already spinning the narrative. They will tell you it was a technical glitch. They will tell you it was a data feed error from the CME group. They will tell you that a fiber optic cable in New Jersey had a hiccup or that a server overheated. Do not believe them. Do not believe a single word of it. What you witnessed in those 11 seconds was not a computer error. It was a circuit breaker. It was the financial equivalent of a desperate man pulling the plug out of the wall because the machine was about to explode. Here's the truth that they are terrified to admit. At 2:13 p.m., silver broke the all-time high. It smashed through the $64 resistance level like it was wet tissue paper. And at that exact moment, the algorithms that suppressed the price, the spoofing bots, the high-frequency trading ladders, the managed money meant to keep you poor, they didn't just fail, they evaporated. There were no sellers left. Let me repeat that, because it is the most critical piece of information you will hear this year. At $64.10, the ask side of the order book went to zero. There was nobody, not a single bank, not a single hedge fund, not a single algorithm, willing to sell paper silver at that price. In a free market, when the sellers disappear, the price is supposed to go vertical. It is supposed to reprice instantly to $70, $80, $100, until it finds someone willing to sell. That is the law of supply and demand. That is how a market works. But we do not live in a free market. We live in a managed illusion. We live in a casino where the house controls the dice. So, when the central computer at the exchange realized that the next trade was going to be $10 higher than the last trade, it didn't execute the order. It panicked. It triggered a volatility pause. They paused the market. They stopped the trading. And in those 11 seconds of darkness, while you were refreshing your browser thinking your internet died, the phone calls were made. The emergency liquidity was injected. The rules were rewritten in the dark. When the lights flickered back on at 2:15 p.m., the price wasn't $75. It was back down to $63. $80. They painted the tape. They shoved the beach ball back under the water. They rebooted the matrix because the glitch was revealing the truth. If you are feeling fear right now because you see red on the screen today, you are looking at the wrong thing. You're looking at the shadow on the wall, not the monster casting it. That glitch was the death rattle of the paper suppression scheme. It was the system admitting, publicly and violently, that it has lost control of the physical asset. They paused the market because if they hadn't, the COMEX would have defaulted before the closing bell rang. This is not speculation. This is forensic analysis of the crime scene. We need to dissect exactly what happened in the engine room of the exchange during that pause. To understand the gravity of this moment, you have to understand how the banks have controlled silver for 40 years. They use what we call the limit order matrix. They stack massive sell orders just above the current price to create a ceiling. It scares off the speculators. It creates a psychological barrier. But yesterday, the buying pressure from the physical market, from the industrial users in Asia, from the sovereign wealth funds, and from the millions of awakened retail stackers like you, was so intense that it chewed through that ceiling in minutes. The banks threw billions of dollars of paper shorts at the rally, and the market swallowed them whole and asked for more. This created a liquidity vacuum. Usually when the price spikes, it triggers sell orders. Traders want to take profits. But yesterday, the higher the price went, the fewer sellers there were. Why? Because the people holding silver in December 2025 aren't looking to trade it for fiat currency. They know the dollar is burning. They know the euro is failing. Why would you sell the life raft to buy a ticket on the Titanic? When the price hit $64, the HFT algorithms looked for sellers to match with the buyers, and they found a void, an empty room. The only way to stop the price from gapping up to infinity was to halt the engine. In that pause, the powers that be, the exchange stabilization funds, the bullion bank consortiums, executed a manual override. They didn't find real metal to sell. They created synthetic supply. They flooded the order book with naked shorts, contracts that are backed by absolutely nothing but the promise of a bankrupt system. They forced the price down to make the chart look like a double top rejection. They want the technical analysts to look at the chart this weekend and say, oh, silver failed at resistance. It's a bearish signal. They are painting a picture for the sheep, but the wolves, the industrial buyers, they saw the glitch, and they know exactly what it means. It means the vaults are empty. You do not pause a market that has liquidity. You do not halt trading when you have plenty of product to sell. You only pull the plug when you're out of ammo. Think about the timing. Why did this happen on a Friday? Why did they fight to the death to keep the weekly close below the breakout level? Because the weekend is their nightmare. In the digital age, information travels instantly, but markets have closing times. The COMEX closes, the banks close, but the conversation doesn't. If silver had closed at $66 yesterday, every news outlet in Asia, every financial blog in Europe, every TikTok and YouTube channel would be screaming breakout all weekend long. The FOMO, the fear of missing out, would build up pressure like a steam boiler for 48 hours. By the time the markets opened in Shanghai on Sunday night, the demand would be a tsunami. The banks cannot fight a tsunami. They can only fight a tide. So they had to crash it. They had to create a red candle. They had to make you feel stupid for buying the top. They had to make you doubt your conviction. It is psychological warfare. They are betting that you are weak. They are betting that you are impatient. They are betting that you will look at the electronic price, see the dip, and sell your physical position to cut your losses. But look at the volume. This is the smoking gun. During the crash, that sharp drop right after the glitch, the volume was suspiciously low. In a real sell-off, in a real panic where everyone is rushing for the exit, the volume bars should be massive. They should be towering red skyscrapers. But yesterday, the volume on the drop was thin. It was robotic. It was the same block of contracts being traded back and forth between two entities to walk the price down. It was a ladder attack. But look at the buying volume at the bottom. Look at what happened every time the price touched $63, $50. Massive green spikes. Who is buying the dip? It's not the retail trader. The retail trader is scared. The retail trader is reading the headlines about silver volatility. The entity buying the dip is the entity that caused the glitch in the first place. It is the shadow order book. It is the industrial complex. You have to understand companies like Samsung, Tesla, and First Solar do not gamble. They do not care about the RSI or the MACD. They have production schedules. They have factories that burn through silver every single hour of every single day. If they run out of silver, the factory stops. If the factory stops, the stock crashes, the CEO gets fired, and the company dies. To them, the price of silver is irrelevant compared to the availability of silver. They saw the market freeze yesterday. They saw the exchange admit it has a liquidity problem. And that terrified them more than any price hike ever could. To an industrial buyer, that glitch was a signal that the supply chain has snapped. It told them that if they don't secure their metal now, they might not get it at all. So while the paper price was being walked down by the banks, the industrial wholesalers were sweeping the physical market clean. They were buying every bar, every coin, every grain of silver they could find at the discounted price. The banks are trying to suppress the paper price. But in doing so, they're accelerating the physical drain. They're making silver cheaper for the very people who are taking it out of the system forever. It is a suicide mission. This brings us to the Monday gap. I want you to prepare yourself for what is coming. The banks played their last card yesterday. They used the margin nuke threat, raising the cost of holding futures by 50% overnight. They used the technical glitch, or nuts. They used the media blackout. And yet, silver is still hovering near its highs. They threw the kitchen sink at the market, and the market didn't break. This creates a state of maximum tension. The shorts, the people betting against silver, are now trapped. They are holding short positions that are underwater. They are praying that the weekend news cycle scares you into selling. But what if it doesn't? What if the news about the glitch spreads? What if the people realize that the pause was actually a default in slow motion? When the Asian markets open on Sunday night, there's a very high probability of a gap up. This means the price will open significantly higher than it closed. It might skip $64 entirely and open at $67. If that happens, the shorts are dead. They will be instantly margin called. Their computers will force them to buy back their positions to cover their losses. And their buying will drive the price even higher. It becomes a feedback loop. A short squeeze of biblical proportions. The glitch was the tremor before the earthquake. It was the water receding from the beach before the tsunami hits. And let's talk about the narrative they are trying to spin right now. Go to the mainstream financial news sites. What do you see? Silver volatile as traders take profits. Gold holds steady while silver stumbles. They are lying to you by omission. They aren't telling you that the COMEX registered inventory dropped by another 2 million ounces yesterday. They aren't telling you that the premiums on physical eagles just jumped 10%. They aren't telling you that the US Mint has quietly suspended orders again. They are trying to keep you in the paper matrix. They want you to look at the spot price and feel poor. But if you hold physical silver, you are not part of their matrix. You are the battery that they are losing. Every ounce you hold is an ounce they cannot rehypothecate. Every ounce in your safe is an ounce that cannot be sold 500 times in a millisecond to suppress the price. You are the bank run. The glitch yesterday was a moment of clarity. For 11 seconds, the illusion failed. For 11 seconds, the true state of the market was revealed. No sellers, only buyers. Infinite demand meeting finite supply. The price of silver, the real price, is not $64. The real price is unobtainium. The real price is we have none left. When the market unpaused, the number on the screen was a lie. It was a fabrication designed to buy them time. Maybe one more day, maybe one more week. But they cannot print silver. They can print dollars, they can print contracts, they can print news stories, but they cannot print the chemical element ag. And we are running out